I'm Jeff Nalley. This is the morning edition here on the Cromwell Ag Radio Network. David Owens joins us. He is the President and Chief Executive Officer of Farm Credit Services of Illinois. Sitting in the middle of Progress City, the whole planet is looking to the future of agriculture, and they're looking to Decatur, Illinois in this 75-acre section. It's kind of nice to be singled out and be the center of an industry that appears to have a lot of upside.
This show gets bigger every single year, and Farm Credit is fortunate. We've got a tent right by the front gate here. It's very prominent, very happy to provide entertainment, and it's a focal point for people coming to the show. They'd like to come there and say, I'll meet you back here in a couple hours, that sort of thing, so it's a gathering point. But yeah, you're right. Agriculture in the middle part of the United States here is very good right now. Not so much on the East Coast, Southeast, of course, even the Northwest. Those industries, agriculture to them includes a lot of different things. It's not just grains. Timber industry in the Northwest has been hurt really bad. The Northeast has a lot of nursery type businesses there. Those, of course, have been hurt real bad. And then just the valuation of real estate, period, in the South, Southeast, and Southwest has caused a lot of problems there too.
When we look at this industry, we know it's cyclical, and we have paid our dues in the downtime, but we always said this would happen. There will be a day in coming that agriculture will be called on to cross hurdles and boundaries that we couldn't see. And we're crossing those, but we still have a long way to go. I think Wall Street is paying attention to what's happening in agriculture because in all of our economy, we may be the bright and shining star.
It is the bright and shining star. And as I just said, it's good to be employed.
It is. It's
good to be employed in agriculture. It's good to be employed in agriculture here in the Midwest. And I would say, further drill down, good to be here in Illinois.
The Department of Agriculture shares that for the first time, our net farm income this year is going above $100 billion, $103.6 billion. They suggest that we will spend over $300 billion in agriculture. We will spend $300 billion in investments for the production of the business. That's a whale of an impact.
That's a large number, no doubt. The farm balance sheets that we look at are about as strong as we've ever seen them. Equity positions are really strong. Working capital positions are just very, very good. And that is a little difficult for a lender in agriculture because a lot of people have cash. That offsets their loan demand. But I tell you what, I'd rather have those strong balance sheets than the other.
A lot have talked about, a double dip in recession, and certainly there are questions in the economy for how we're doing. But in terms of agriculture, those balance sheets being strong now, much better than years before when we ran into similar issues.
It gives them a lot of buffer, and also the farm operations day, in addition to not being as highly leveraged, crop insurance is a big thing. There's a net there to fall back on, and most operators now are buying crop insurance. That wasn't the case back in the 80s. And things really couldn't be better here right now. You mentioned cycles earlier. That's always a concern. Things never stay the same. Right now, the value of farm real estate is high, in part because farm earnings are good, as you just mentioned, and interest rates are extremely low. Well, the farm earnings are impacted by high commodity prices. How long? Is corn going to be at $7.60 and beans at $14.50? I don't know the answer to that. Some would say that the U.S. may become the Saudi Arabia of the food for this whole world, and I hope that is the case because we're sitting right in the middle of the breadbasket for that. So maybe commodity prices could stay high. Input prices will probably rise. The more net farm income there is, generally speaking, over time, the inputs rise as well and kind of soak some of that up. But one thing we are for sure that's going to change is interest rates. They're extremely low, and they're not going to stay where they are. You'd have to think, well, will they go down? That'd be hard to predict. They'll probably go up. And just a 1% increase in interest rates has a pretty significant impact on the value of farmland.
And if you start to affect the value of farmland, then you start to affect the equity or the capital that is tied to so many of those operating loans in the country. Again, not being a doomsdayer, but also recognizing we can't stay at this level, and we certainly can't go a lot lower. So the only other way is up.
Some like to say that they think there's a bubble developing in farmland values, and I'll tell you, if you look at the farm income and the interest rates, those are one way to look at the value of farmland. Those are strong. What is going price for farmland today on Class A farms is $10,000. There's some up there $13,000, even more. But for the most part, $8,000 to $10,000 is a pretty reasonable, familiar price to everybody in the market right now. demand for farmland is high. And when things are moving upward all the time, investors are heavy into buying things like that. Well, investors are active right now, but not like they were just a couple of years ago. Most of the farmland is being bought by farmers. There's more demand for it than there are people willing to give it up and sell it. We're seeing more auctions here in the last probably 9 months than we did in the last couple of years. A lot of private sales going on then, but we're very optimistic about the values staying up where they are. We're hopeful that those factors we talked about will remain in place for quite a while.
Do we need to delineate, and I think we can easily delineate the difference between a crop producer, primarily a crop farm, and a livestock operation, especially splitting between dairy, swine, and beef?
Well, yes, that's true. Let's see, pork carcass prices today I didn't look at the March date, but $94, $95, and cattle about $1.15, something like that. Those are good prices. The pork industry 2 years ago went through a 2-year spell that just was devastating to them. A lot of equity got burned out in those operations. They're having some opportunity to make some of that now. Those operations, all livestock operations, are contingent upon their contracts. They're trying to contract for the feed and trying to contract for the slaughter are big things. They protect themselves as best they can, but eventually those contracts do expire and have to be renegotiated.
Right.
And to the extent that they're expiring today on the feed side, their input costs will go up.
When we look at Washington now, agriculture programs back in the mid-'80s were a huge part providing a floor and a ceiling both for commodity prices. Washington's spending less money on programs than they had before. And now the question is, how much more of a cut will we see? Will the 08 Farm Bill survive to expiration without being cut? And what type of a balance sheet will we have? What type of number will we have to work in writing the 012 Farm Bill? As I'm speaking with a lender now, the crop insurance that you mentioned earlier is critical for the success of farmers today, because $400 to $600 an acre in corn, you're not going to be able to make that loan without some guarantee you're going to get paid back. Washington, in an opinion, and I think of other that is shared by other farmers, Washington could cut too deep here.
We're obviously concerned about that. The input prices and the commodity prices we're talking about, we all know they cycle. They go up and down. And, farmers are one of the few people that produce something. They can't control the price. The Lord controls the production more than we think. This is one of those years. And so they're sitting there. There's national security involved in having a good, inexpensive source of food in this country. And so the U.S. government needs to consider that when they think about cutting back. If they leave the crop insurance program in place and keep subsidizing that, which they do, that goes a long ways in safety net.
There are some who are mentioning the combination of perhaps an acre program and a sure program sort of working together in a way to help in a manner that's not tied to bushels, but that's tied to revenue.
Those are new products that come in the crop insurance industry probably in the last 5 to 7 years. That's so much better than just yield protection. Those programs are getting more traction with farmers. They like to look at those programs instead of buying crop insurance through, the private industry. But overall, crop insurance is a risk mitigation tool for a lender. We don't absolutely require it of our borrowers, but we sure encourage them to buy it.
Surely. Now, when we think about one other area, the president has, the administration has offered a number of different changes in the way lending is done, especially for homes. A lot of correction perhaps for Fannie and for Freddie, and more being suggested from the Commodity Futures Trading Commission. How has agriculture and farmer impact been affected through this wave?
Really a big issue right now. The Farm Credit System is a government-sponsored enterprise. It was created in 1916 through an act of Congress. The initial dollars loan were seed money from the U.S. government. That did get repaid over time, but we are still considered a government-sponsored enterprise. Farm Credit raises all of its loanable funds and costs for operations from the sale bonds. Those bonds sell in the market just a little bit over U.S. Treasuries because there's this assumption that we're tied to the U.S. government, which we really aren't. Fannie and Freddie, big mistakes been made there. Those mistakes were not made in Farm Credit. Back in the 1980s, farming and Farm Credit went through a crisis, and at that time, the regulations came on us then. Our consumer protection things got put in place, borrower rights got put in place, and our regulations got tighter. Well, the banking industry now is probably just catching up with some of those things. This round, through the legislative process, Farm Credit has been pretty much excluded from it. We have not been subjected to the Dodd-Frank regulations, for example, but Farm Credit is a prudent regulator, and if those things make sense in lending, what they do, even though they're not required, they like to come along and mimic some of those things.
Are there thoughts that you might have about the Commodity Futures Trading Commission approving now a wider margin for corn, 40 cents a bushel a day? That's a wide margin. I remember when it was a lot less.
Well, what do you say? I mean, when corn was $2.50 or $3, 20, 30 cents was a big thing. So I don't know. What if we could do anything to cut the volatility down from day to day and week to week? That would certainly help all of us. It would make sense, I guess, to increase it somewhat because the dollars involved are just much greater today.
I understand. Okay, for 2012, looking ahead, working with your partners, if they're making plans, whether it's capital or just operating, thoughts they need to keep in mind as they come see you?
Well, a couple things. One of them is keep leveraging your operation reasonable. The land prices are high right now, but what happens is they're taking that land, they're absorbing it with the other real estate they own, and all that makes sense to us. Crop insurance, as we said earlier, is very important as a safety net. Records, keeping good records. The farm operations are getting larger and larger, more throughput, more dollars, and what we find is we would like to see the records improve somewhat.
Dave Owens, President of Farm Credit Services of Illinois. 2011 a challenge, looking ahead to 2012 and the site of the largest outdoor farm event in North America, the 58th Annual Farm Progress Show here in Decatur, Illinois.